What we're really focused on is thinking long-term, putting the customer at the center of our universe, and inventing. Those are the three big ideas to think long-term, because a lot of invention doesn't work. If you're going to invent, it means you're going to experiment, you have to think long-term.
When it comes to investing, compounding is one of the most important, if not the most important concepts to understand. Whether you're investing in stocks or a more secure financial instrument like a certificate of deposit over time, compounding will result in exponential growth of your investment. There are many ways to build wealth, and everyone who has amassed a fortune has their preferred method. Sometimes it involves real estate development. Other times, an investor lucked into getting in on a high-growth stock early. However, in a vast majority of cases, success is a simple matter of discipline and determination. In this video, we'll show you the best stocks that can turn you into a millionaire over time. Let us know in the comments below if you think investors should invest in stocks for interest, growth, or both. Now let's get it on. Since the coronavirus bear market, stocks rebounded powerfully. The strong action reflected rising confidence that the world economy would eventually recover from the coronavirus. Worries about COVID grew with the emergence of the Omicron variant, but there are hopes that this coronavirus strain will soon be contained. Buying a stock is easy, but buying the right stock without a time-tested strategy is incredibly hard. That said, here are the best stocks to invest in today. Number 1. Amazon stocks. The coronavirus pandemic is a horrible thing. More than 219 million people around the world have gotten sick, with more than 4.55 million people losing their lives. There's no downplaying the seriousness of this illness. However, even the darkest cloud has a silver lining. Online retail companies have been prime beneficiaries of the crisis. For months, consumers were told to stay at home, only leaving the confines of their home in search of absolute necessities. While there were already growing numbers of consumers shopping online, travel restrictions and temporary lockdowns led to a tidal wave of consumers who shifted from brick-and-mortar shopping to shopping on the web. Naturally, Amazon.com, one of the most successful e-commerce websites globally, seemed likely to benefit significantly from this trend, and benefit it has. Since June 2020, the company's stock price has climbed from around $2,545 per share to nearly $3,500 per share. With this kind of growth, the e-commerce pioneer has not only become one of the largest companies in the world, but one of the strongest growth stocks on the market today. As a result of the growth, the stock trades with a pretty high valuation, with a price-to-earning ratio of around 60, compared to the e-commerce average of approximately 55. All in all, with e-commerce dominance at a time when more and more people are shopping online, Amazon.com stock is one to put your money on. A clear path to wealth. Number 2. Upwork stocks. Upwork is a tech play focused on connecting contractors and those in need of contract work in the gig economy. Those who need articles written, graphics created, websites built, voiceovers added to videos, and a long list of other services will find talented experts in these crafts on the company's website. Of course, Upwork needs to make money in the process, and it makes plenty. To use the platform, freelancers must agree to the following fee schedule. Freelancers pay 20% of their billings to the company for the first $500 paid by a new customer. From $500.01 to $10,000 in billings of the customer, the platform charges a fee equal to 10% of its billings. Finally, for all billings of a single customer with total billings of $10,000.01 or more, the company takes a 5% cut. Prior to the coronavirus, the gig economy was already taking off. Consumers who have dreamed of working from home finally had a way to do so. Then, as the world shut down, the gig economy boomed. Businesses deemed to be non-essential were forced to close their doors. This left many workers without a job and standing in unemployment lines for a long time. Many of these displaced workers began looking for work-from-home opportunities, leading to a flood of demand for Upwork and its competitors. Moreover, this increased demand is likely to continue. There have also been significant changes for employers. Employers now have access to talent around the world, not just in close proximity to the office. What's more, companies are finding out that not only do workers prefer to work remotely, but they're more effective when they do, according to Business News Daily. COVID-19 led countless companies to realize this, many of which say they'll never bring employees back into the office, according to CNN. Analysts absolutely love this stock because of the growing work-from-home trend and Upwork's ability to capitalize on it, demonstrated by its significant revenue and earnings growth. According to TipRanks, 4 analysts cover the stock, all of whom rate it high. Price targets range from $57 to $76 per share, averaging to $67.50, and suggesting the potential for nearly 50% gains compared to current levels. Granted, you shouldn't blindly follow Wall Street analysts, but these ratings are encouraging. The bottom line here is simple. Upwork has seen tremendous growth already, and considering the flourishing of the gig economy and the trend towards remote work, that growth is likely to continue. As a result, this stock is one to pay close attention to. Number 3. Apple stocks. Staying on the tech trend, Apple is next on our watch. With a market cap of more than $2.46 trillion, the tech giant is one of the largest companies in the world, the largest company listed on the Dow Jones Industrial Average. Like the stocks we've seen, and those that will follow, it's become a household name. As you likely know, Apple is the creator of the iPhone, iPad, and Mac computers, with the iPhone representing the vast majority of the company's revenue. The stock had a solid start to the year in 2021, but gains tapered off in late January and again in late February, bringing the stock down to what many believe is a discount. While the stock has rebounded from the lows, there's still a strong argument that the stock is undervalued. But still, the company has enjoyed tremendous growth. Some argue that the growth results from Apple's status as the leading global device manufacturer. Others say that the growth was fueled by spending as a result of stimulus payments given to U.S. consumers. Some say it's a mix of the two. No matter where it came from, the growth is impressive. Notwithstanding recent volatility, the stock is currently trading with a relatively high valuation compared to the industry average. However, like other big tech names on this video, the high valuation associated with the stock is offset by the strong growth seen in revenue and earnings, which many believe will continue for the foreseeable future. Number 4. Gevo. Gevo isn't necessarily the type of company you would expect to see on a compilation like this. The company is anything but profitable, and the stock was still trading in the penny category in late 2020. Nonetheless, Gevo saw a phenomenal rise in 2021. Year to date, Gevo stock has climbed by more than 60%, and that's after recent profit-taking as the stock touched record highs. Gevo is a clean energy company, but the company isn't making solar panels, windmills, or batteries. It's focused on producing clean, renewable fuels, making it an exciting take on exposure to energy stocks. Over the past several years, the company has perfected technology that allows it to turn renewable feedstock like waste wood and food scraps into clean, renewable fuels, including jet fuels that have been used to power commercial flights. Recently, Gevo has been getting quite a bit of attention from proponents of clean energy and demand from airlines and fuel distributors around the world. That attention has been amplified in recent months due to a change in political tides. With President Joe Biden in the White House and Democrats in control of Congress, many expect major clean energy legislation in the coming months. As a result, companies that operate in the clean energy space are likely to benefit from the following: grants that will likely be provided to clean energy companies like Gevo to fund research and to increase the supply of clean energy products. Tax cuts. The federal government is likely to further support clean energy companies through tax policies that benefit green energy producers, helping those companies to keep funds in-house and offer more competitive pricing of clean energy to consumers. Increasing demand. Many expect tax credits to be provided to consumers who take advantage of clean energy products. Should this be the case, consumer demand for these products will likely increase. Yet another plus for Gevo. Expecting a rise in demand, Gevo is in the process of building its first net zero production facility, where it'll be able to produce massive amounts of clean fuel with a net zero carbon footprint. The facility is expected to be completed and operational in early 2022. This has quite a bit to do with its lack of profitability. The company is following a growth business model like that of Amazon.com, investing in infrastructure early to stay ahead of the curve later. At the same time, Gevo has a strong balance sheet due to a recent capital raise, and with the clean energy movement gaining steam, it has plenty of support from the retail investing community. This, combined with a recent dip in price that creates a compelling value opportunity, makes Gevo stock worth its position on your watch list. Number 5. Netflix. Netflix, like many others on this video, is a household name. The company rose to fame by giving consumers the ability to stream entertainment rather than buy it or subscribe to cable services. In fact, the company is known as one of the pioneers of streaming video. As with other home entertainment stocks, COVID-19 proved to be a positive for the company, resulting in increased subscribers, revenue, and earnings. However, early 2021 wasn't so great for the company. As competition continues to flood into the space, many wondered if the company had what it takes to maintain its leadership position. Its stock suffered steep declines from mid-April through mid-May 2021. However, those declines proved short-lived, with the stock currently trading above early-year highs. Although it's made up for the losses, there's a strong argument that there's plenty of room left in the recovery, especially with Netflix continuing to pour cash into developing exclusive content. Moreover, the concept of cord cutting isn't expected to dissipate anytime soon. In fact, as the cost of cable services continues to climb and consumers focus on saving money, cord cutting is likely to continue. Sure, there's plenty of competition on the playing field, but it's hard to bet against a pioneer, especially one with a long history of investing in content, technology, and marketing strategies that have yielded fruit. All told, Netflix has competition to contend with, but as it continues to develop market-leading content, offer services at competitive prices, and expand its membership base through effective marketing strategies, the stock has plenty more room for growth. Whether you're looking to invest in the stock market for the first time or you want to rebalance your portfolio to take advantage of the hottest trends today, the 5 stocks we've covered are compelling opportunities to look into. Which one of them would you settle for? Let us know in the comment section below.